Good evening, everyone, and welcome to The Money Show. I'm Avan Dabash. Well, over the next half hour, it's going to be a sort of a different show. We're not going to necessarily discuss mutual funds as well as tax and insurance, but we want to help empower our viewers to understand the basics of how to identify a good company, when you should see the red flags raised in a company, as well as the essentials of how to identify a good business. To help us and guide us over the next half hour, we have a special guest joining in on the show. Anil Lamba, he's of Lamcon Finance and Management Services and author of the book Romancing the Balance Sheet, which I have read, and we will talk about some of the key pointers in that book. But I'm going to begin with a quote, Anil, that you've made. Sooner or later, everyone realizes that their ability to lead successful businesses largely depends on the ability to read balance sheets. And oftentimes, you've noticed that doesn't necessarily go hand in hand. So what is the first step of advice, or what are the first basics that you would tell people to do? Those who, steer clear, say it's too many numbers, I can't manage this. What would you say to break that sort of a myth and, the importance really of understanding a balance sheet?
Yeah, I think you used the right word, break the myth, because this subject is full of myths. Number one, most people think finance is a difficult subject. Number two, they think it's a boring subject. Now, when somebody says it's boring, my question is, how can money ever be boring? So it's not at all boring. It's almost verges on entertainment. And number two, it's an absolutely common sense subject. But by staying away from finance in general and balance sheets in particular, people pay a huge price. Now, I often ask, who should know how to make balance sheets? Can you afford to spend the rest of your life saying, I don't know how to make a balance sheet? Answer is yes. You may not know how to make a balance sheet at all, and no big deal. But no one should ever say, I don't know how to read a balance sheet. If you say so, you will pay a price for that. Now, who should know how to make balance sheets? Accountants. And who should know how to read balance sheets? I think everybody. Within an organization, everyone. The more senior one becomes, the more necessary that skill becomes. I think there can't be a managing director alive who can afford to say, I don't need to know how to read a balance sheet. If he says so, either he won't remain a managing director for long, or the organization whose MD is won't remain for long. I often say that, when I'm addressing a Tata Group company, which I do very often, I always tell them that, Mr. Ratan Tata can afford to say, I don't know how to make a motor car. And no big deal. Tata Motors can continue to flourish. But if Mr. Ratan Tata was to ever say, I don't know how to read a balance sheet, he will probably jeopardize the entire fortunes of the group. And therefore, that statement, sooner or later, everyone realizes if they have to lead successful businesses, they have to learn how to read balance sheets. But to learn how to read balance sheets, you don't need to know how to make them. So my appeal to your viewers is, please take the effort, and this one effort will pay you tremendous dividends in your life.
Absolutely. Knowing and reading and understanding the balance sheet is absolutely detrimental to any business to perform. Now, let's talk about individual businesses. Now, we at ET Now are talking about the stock markets day in and day out, investing in a slew of companies, large caps, mid caps, those across the board. And of course, there's so many ways of, classifying different businesses. But you've stressed on this point, and you've spoken about it a lot, identifying the red flags in a balance sheet. And even when you invest in a company and you do enough homework about it, you need to watch out for the red flags in the balance sheet. So what are the factors do you think someone should read or look at and say, hey, I should wake up and take notice. If I'm putting my money in this company, there's a high chance that it could potentially be set up for failure. So I believe there's a checklist of about 7 things that you should watch out for, or the red flags, if you will. What are they?
Yeah, this question is very small, but the answer is very, very long. So I'm going to try and condense it as much as I can. And for that, one should have a working knowledge of a balance sheet. And to put it extremely simply, a balance sheet is merely a statement which tells you, on the one side, it tells you where the organization has raised its money from, and the other side tells you what it has done with the money. Liabilities represent sources and assets represent uses. Now, typically, money comes in an organization from 2 sources. owners and outsiders. Owners' contribution is called capital, direct contribution. Owners' indirect contribution, when they leave behind the profits, appear as reserves. Outsiders lend you money in cash, which appear as loans. Outsiders lend you money in kind. You may go to a vendor and buy raw materials. You may borrow raw materials instead of borrowing money. So those appear as current liabilities. So there are only two sources of money. And the money goes again only into two avenues. You use the money to create infrastructure, which appears under fixed assets, and you use money to provide working capital. Infrastructure could be a one-time investment or once in several years. Working capital is a continuous requirement. In addition to buying infrastructure, you need working capital so that you can afford to invest money in buying and maintaining inventory if you're a manufacturing company. You need money to be held in cash because inflows from operations don't happen every day, but expenses take place probably on a continuous basis. So you must have sufficient money in hand so that you can do that. And business also requires that you go on spending, make a product, and then a customer buys it from you and says, I'll pay you a month, 2 months later. So you need to fund your customers. So very briefly speaking, this is what a balance sheet is. Now I made you go through this so that I can then tell you what to look for in a balance sheet. Now, in my opinion, and it's an established fact in the world, out of every 10 businesses that shut down, more than 9 shut down on account of bad finance management. And I think the primary reason for this, I can bring it down to 2 factors. Now, one of the things that most business people are ignorant about is their cost of capital. Everyone knows what's my cost of production, what's my cost of marketing, what's my cost of administration. But what they don't know is what is the cost of money, what's the cost of capital. So the first thing every entrepreneur should do is to figure out their weighted average cost of capital. And the reason there is a grave ignorance or misconception is that there is one of the important sources of money is capital, owner's money. And there's a perception that this is free. Now, equity, the owner's contribution is not only not free, it is the most expensive source of money available. Now, why should you know your cost of capital? Because liability side represents sources and asset side represents uses. The sources have a cost and the users have an obligation to earn. And they must earn for you at least equal to the cost of capital. Now, when you don't attribute a cost to equity, your perception of cost of capital is very less because you only think debt has a cost, which is the cheapest money incidentally. And then if you earn greater than the cost of debt, you're under a false illusion. You're under an illusion that you're making a profit. Whereas the leftover profit is not even sufficient to cover the cost of capital. And this single factor leads to major problems. And their companies and entrepreneurs are blissfully unaware of this. Now, this may sound very easy to listen to because you may think, how is it possible that such successful businessmen, don't they understand? I've been talking about this for too many years, but I was reading an article by Bain and Company that Bain and Company research has found that in the US, 9 out of 10 businesses routinely fail to earn even the cost of capital invested in them. Now,
Okay, so that is a very key point that you brought up. But I want to try and take on board some of your questions as well that we have, Anil, and I want to talk about investing in public provident fund and so many things to really discuss. So let's begin by taking on board Pooja Shet's question. She asks, how should a business be funded? What is the ideal way, using debt or equity? What are the advantages of both of them, especially while identifying a good business, according to you, Anil?
Pooja's question I seem to have preempted because I started talking about the cost of equity and debt. So since equity is the most expensive, it makes ample sense to have a fair dose of debt. If you think debt has a cost and equity doesn't have a cost, many companies would use equity, and very often they use equity because they think the business can't afford borrowed money. I know so many entrepreneurs who are doing some planning for projects, they do some cash flow projections, they study the projections and they try and take a call, can we afford to borrow? They say, no, this business can't afford borrowed money. So what do? Let's use owner's money. Folks, you must understand, if your business can't afford borrowed money, it definitely does not deserve your money. So, from a cost perspective, if you want to lower your cost of capital, it is essential to have a generous dose of borrowed money. Now, problem is not with borrowing. Lots of companies have borrowed and gone under, and then they blamed, my business failed because I borrowed. Folks, you didn't fail because you borrowed. You failed because you did foolish borrowing. Because I have two golden rules of success in business. One is that you must understand all sources of money have a cost, including equity. And when you deploy the money in acquiring assets, those assets have an ability to earn. You must never ever invest your money without ensuring that what you can earn through the deployment of money is equal to or greater than the corresponding cost of capital. But when you think equity is free, your perception of cost of capital is less. And therefore, you're earning probably way below cost of capital and you don't even know it. And that leads to a serious problem. And then you start wondering, who am I working for? I think I started this business so that I can generate employment in the country. Because except for the owner, everybody's making money. Second thing that happens is debt comes with an obligation to pay back. Now, when you invest your money, your assets have the ability to generate income and they can also bring a cash inflow. So the liabilities sooner or later will demand a cash outflow. Assets will bring a cash inflow through the generation of income. It is essential that the assets bring an inflow before the liabilities demand an outflow. Now, if one of these two things gets violated, you will get into trouble. So you must borrow provided these two rules are not violated. If these two rules are satisfied, folks, the more you borrow, the more you will prosper.
Okay, that is such a crucial component in terms of understanding how a business should really be funded and some of the traps as well that a lot of businesses get themselves into. Well, to all of our viewers who are watching, I just want to remind you there is a number flashing at the bottom of your screens. So if you have any general questions about understanding your finances, how to identify good businesses, look, tips on raising funds as well for companies and essentially romancing the balance sheet, please feel free to dial into the number that's at the bottom of your screens. In the meantime, I'm going to take Jamal's question, and he says, everyone advises investors to invest in companies that have no debt. And yeah, that is the no-brainer, but there are very few listed companies that are completely debt-free. So he asks, what do you think of companies that are completely debt-free? How does it really work? Because they're few and far between, Anil. It seems like the ideal formula for picking out a company, but do they also have their issues?
I seem to be coming out as a great proponent of debt. I seem to be advocating debt, but for heaven's sake, I'm not advocating rash debt, subject to those two rules being violated. If you, subject to those two rules be satisfied, if you borrow money and commit to pay an interest of 12% and don't even have the ability to earn 10%, and then you get into trouble, that's foolish borrowing. Similarly, if you borrow money and commit to a banker, I'll return it in 3 years, and the money can't come back in, say, 5 years also, that debt should not have been taken. But if you can recover more than the cost of debt, and inflow can happen before you have to pay back, the more you borrow, the better it is. And therefore, I've never understood when companies get up and say, we are a debt-free company, and they seem to be very proud of it. I've never understood, are they boasting or are they apologizing? Because what I can't take you into right now, being a technical topic, is the benefit of leverage that debt brings to you is immense. And when I say debt, I don't mean keep your money at home. But first, put your money, because there has to be skin in the game that shows commitment on your part. But if your business needs 100, and if you have 100, then my suggestion is, if you can borrow against 100, 200, then start a business worth 300. Don't start a business worth 100. So you can scale up with the help of debt. If you only use your own money, your growth is going to get, you're going to hit a ceiling sometime or the other. And only those people who say, my business can't grow anymore. I've reached a level of stagnation. If those guys say, I won't borrow, I can understand. But then I still won't invest in such companies who have reached a level of stagnation. So I don't agree with that.
I like that you said when a company says that they're debt-free, you've never understood whether they're actually boasting or apologizing. We'll tell you what, Anil, stay on with us. We've got lots more to chat about. There's a number that's flashing at the bottom of your screens. If you have any questions for Anil Lamba, pick up the phone and dial in. For now, we take a quick break. Coming up on the other side, why you should be investing in public provident fund right now and what the importance is when it comes to companies managing their finances. Stay with us. Welcome back. This is the Money Show. We're in conversation with Anil Lamba, Director, Lamcon Finance and Management Services and author of Romancing the Balance Sheet. We're breaking it down for you. Time to take control of your finances, identify good companies. We've got a live caller with us. Shabir is connecting with us from Mumbai with a question. Welcome to the special show today, Shabir. What's your query?
Yeah, ma'am. I am a small investor. We are there in the market for last 20 years. We try to understand how to invest and to read out the balance sheet. But as a layperson, we don't understand certain technicalities about the debts and the earnings and ROE and all. How do we really understand the balance sheet of the good management company like?
Anil, your first tip should not be read my book. I want you to break it down as to, it's a very valid question because there are a lot of technicalities, there's a lot of jargon. What exactly do you want to tell him? Because he says that he has admitted that he does research a lot of his companies, he does his homework, but of course, there are bumps along the way. So what are the basics?
Again, very difficult to say in a couple of lines. I wouldn't have said so, but because you said the answers are there in the book, or maybe mine or others also. But Shabir, one of the things that causes most businesses to fail is the tendency amongst business people to use short-term money to acquire long-term assets. In fact, the large majority of businesses that fail, the single factor is this. And therefore, one of the things you can see in a balance sheet is, has this company been doing that? Now, how do you find that out? If you were listening in earlier on, I just mentioned a balance sheet. One side tells you where the money has come from and second side tells you where the money has gone. So all the money that comes in, you can break it up into long-term sources and short-term sources. And to put it very simply, out of all your sources, if you eliminate the current liabilities means money that has to be paid back within a year. So if you eliminate that, the rest of the sources are long-term sources. Similarly, on the asset side, those fixed assets represent long-term uses and the current assets represent short-term uses. So if you do these four figures, are you with me? Left-hand side, long-term sources, short-term sources. On the asset side, long-term uses, short-term uses. In case you find this company's long-term sources number is smaller than the figure of long-term uses, that means part of the long-term uses have been funded from short-term sources, and that is a big red flag. In other words, it is essential that the long-term sources are greater than long-term uses, which means all the fixed assets have been acquired from long-term sources of money, and some long-term money has been used even for working capital purposes, which is fine. But never ever use short-term money for long-term purposes. If I have to give you a single piece of input, I think this is a good one.
Okay, so you tried to sum it up and you tried to give him that answer in brief, but of course, I hope we were able to help you out, Shabir, sir. Let's move on then. And since this is a personal finance show, since investors look out to us for investing via different avenues, you seem to be absolutely gung-ho when it comes to public provident fund. Why is that? Why are you telling investors, if you're watching this, if you're reading now, go invest?
I think PPF is one of the finest accounts there is, which gives you tax saving, which is a wonderful investment, all rolled in one. There are some others also. I'm not saying PPF is the only one, but I think those who are not employed, because they have the facility of EPF, but everybody else must have a PPF account. Now, good old days, there used to be a national savings certificate, which was a 6-year. Nowadays also it is there, but it used to be a 6-year deposit. So many people would opt for an NSC over a PPF, which was a 15-year account, because what used to put them off was the 15-year period. And this is purely out of ignorance. What is good about PPF is the long duration. In fact, PPF should not be opened only for 15 years, it should be lifelong. Because after 15 years, you can extend it for 5 years at a time, every 5 years. So it can become a lifelong account. And I think one of the finest gifts a parent can give to the kids is to open a PPF account the day the child is born. I think my son's account we opened when he was 3 months old because it took us 3 months to think of a name for him. Otherwise, we would opened it day one. Everyone hears about the power of compounding. You know, if you see some investment made somewhere where you don't get compound returns and somewhere else you get compound returns, 5 years down the line, there's not much of a difference. 10 years down the line, a little bit difference. But 50 years down the line, an account which gives you compound interest has a tremendous difference. So in my opinion, if you have a PPF account open for a child and till the child becomes a major or starts earning, the parent invests over there. And then when the child starts earning, the child starts putting money in his or her own account. And therefore, this account can run for 60 years. Not too high an amount to be invested. I think if you do no other retirement planning, this single account is enough to sustain you thereafter.
Okay.
I numbers now, but the numbers are humongous. Hundreds of crores.
Right.
Actually. So,
right. Anil, point really taken. And, it's as you said, one of the best gifts that you can give your child. The power of compounding and PPF is going to do the trick for you. Next up, we have a question. And as I'm telling our viewers, there's a few more minutes left with Anil Lamba. If you have queries, reach out to us. He asks, is it better for organizations to have more fixed costs or more variable costs?
you're coming out with such wonderful questions because fixed cost is again a misunderstood area. I love to ask the question in my workshop, when do organizations make more profit? When they have a higher amount of fixed cost or a lower fixed cost? And the normal answer is lower the fixed cost, higher the profit. That's absolutely wrong. If your fixed cost component is higher, you start enjoying the benefit of leverage, which leads to an exponential increase in profit. This statement may not make sense now. So when I say higher fixed costs, I don't mean go on inviting fixed costs. Don't call your HR person and say, we double everyone's salaries from tomorrow. Don't ring up your landlord and say, what rent are you charging me? Can I pay a little more? Don't do that. That will take your profits down. So when I say higher fixed costs, what I mean is your costs should not go up, but your fixed cost component should go up. Now, how can that happen? That can happen if you start swapping what was a variable cost with a fixed cost. And I must also tell you, this strategy is meant for good days. Good days meaning you expect sales to be rising. Markets are booming. There are lots of business to be taken. Now, if you visualize a graph, a variable cost graph is linear. If sales goes up by 10%, variable cost goes up by 10%, profit goes up by 10%. But a fixed cost is a straight line. It doesn't remain straight forever. It also goes up, but it goes up with a jerk. So it's a step graph. Now, the advantage is when you have a higher component of fixed cost, if your sales goes up, cost does not go up, and the gap between income and cost becomes bigger and bigger. This in financial language is called the leverage effect. Of course, if you have a higher fixed cost, you first have to work some more. You have to produce more. You have to sell more because your break-even point becomes later. But once you break even, the benefit of leverage starts accruing, and therefore an X%.
I want to interrupt you here because we only have a minute. You brought up a topic of the secret of rich companies. I'm sure everyone wants to know that. So if you could quickly enumerate 3 points.
Okay, secret of successful companies stand on 2 pillars. Pillar number 1, your ability to generate profit. Pillar number 2, your ability to manage cash flows. And funnily, the responsibility of all of this falls into people who call themselves non-finance people. Because at the cost of hurting my own fraternity, I always say if there is one non-finance person in a company, it is the person who calls himself the finance person. Because that person is the only one who does nothing to generate profit. Very important person, but does nothing to generate profit, calculates the profit. Profits are generated by people who are in production, in sales, in marketing, in HR, and so on. And these people paradoxically call themselves the non-finance people. So if all these people understand the subject of finance, if all their actions are financially intelligent, then the organization's bottom line is strong and the organization's cash flow is also positive. So I think if you take care of these two things, according to me, financial intelligence means the ability to understand the impact of every action of yours on the company's bottom line and the ability to understand the impact on the cash flow. If you take all your actions, taking these two things into account, your actions will be financially intelligent and your company will be successful, failing which the company will pay a price.
All right, Anil, I'm afraid we're completely out of time. So thanks much for joining in and giving us, a complete roundup of really the basics of how to read a balance sheet and understanding good businesses, differentiating the good from the bad. We will get you on board soon again on The Money Show. In the meantime, to our viewers, tomorrow is the Home Buyer Special yet again. We have Vaibhav Gaggar, who's the managing partner of Gaggar and Partners, joining in to answer your queries. Send us your questions on The Money Show at etnow.tv.